Hey, Steve Gretzky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. As you can see, a different setup here this week. Actually just in the process of moving, so my new home office is not yet set up. So I figured we have a new change of scenery here, and I felt it was probably pretty fitting. So bear with us probably for the next couple of weeks until that office gets set up. But I wanted to touch on a few things this week. I just did an interview this past week with IceCap asset manager Keith Dicker. Keith's got a global macro perspective. He's been on Macro Voices a number of times, and so I did an interview with him, which I'll put on this YouTube channel probably in the next couple of days. But what I wanted to touch on was sort of my conversation with him preliminarily with him, was this notion of, you know, what to watch for in the Canadian housing market. Because again, he takes a global macro perspective, and I'll never forget when he says, well, you need to watch the Italian bond market. And, you know, kind of what he was alluding to essentially was this notion that if there's going to be a significant pullback, say in the Canadian real estate market, like if the housing bubble ever goes, it's going to be on the back of some sort of exterior event outside of Canada, because Canada is basically this tiny little country that in the grand scheme of things really doesn't matter. So Keith's sort of argument back in the day was, you know, if you have an Italian debt crisis and yields spike up and that ripples through the bond market, you know, the yields in Canada start to rise, and that's probably when you have a crisis. Because ultimately, in my opinion, the only way you're going to see a substantial decline in the Canadian housing space is when yields shoot up. So there's some sort of event in the bond market, and that basically forces the banks to stop lending, to clamp down on lending as yields spike up. Because we certainly know, I think most people can agree, if your 5-year mortgage rate goes from 1.8 today to 3.8, it's game over. So that's kind of the thought process. Now, if we look today, we fast forward today, obviously we can see, you know, global central banks intervening in financial markets, effectively nationalizing, you know, the bond market. So for example, we now have $18 trillion of negative yielding debt across the world. So $18 trillion of negative yielding debt. So it really should not come as a surprise now, for example, when, you know, you're locking in your money for, say, 10 years in Canada anyways, this is Canada, but in many parts of the world you have negative yielding sovereign debt. So for example, in Canada right now, today, you can buy a Canada 10-year government bond. You can buy a 10-year bond and they will pay you 0.7% on your money. So less than 1% on your money. So you lock up your money for the next 10 years. Again, there's an opportunity cost of having your money tied up for a long duration of time. So you tie up your money for 10 years and we'll give you 0.7% on your money. That sounds like an absolutely horrendous, for the average person out there, that sounds like an absolutely horrendous investment thesis or opportunity. Obviously, we understand that banks are forced to buy them. Pension funds are, again, forced to buy some of this debt. So this ultimately destroys the long-term saver, the pensioner, etc. These negative, you know, low interest rates. But again, when you eliminate the bond market, which is essentially the largest asset class globally, when you eliminate that risk-free asset, and you lower the yields now in Canada to 0.7, is it any surprise that you have people speculating on housing here? Is it any surprise that, you know, in Vancouver or Toronto, that, you know, people are happy to buy investment condos with a negative yield, with a negative cash flow every month? So they're happy to lose, you know, $200 a month, because again, it starts to become. I'm trying to paint this picture so you understand where I'm coming from, and it helps you paint a broader understanding of the marketplace, that when there's no alternative, this is the problem. This is why you don't have housing affordability. It's not because of, you know, governments being not enough taxation, or you're not building enough condos. No. It doesn't matter how many condos you build. Yeah, you might slow the pace of price growth by adding more condos onto the market. But at the end of the day, when there's a hunt for yield, when you have the 10-year yielding less than 1%, people are going to be forced into alternative asset classes such as real estate. Obviously stocks, people say, wow, look at the stock market bubble, this huge recession, a lot of these companies reporting, shrinkage or loss in earnings, yet stocks continue to march higher as if valuations don't matter. And again, valuations in a negative interest rate environment, they don't matter because you eliminated the risk-free asset. And so that is kind of the notion that I'm trying to get across. And again, basically where we're heading to now is this complete nationalization of government bond markets. So eventually, again, in Canada, the Bank of Canada owns 35% of the bond market. And by this time next year, they own 50%. You're well on your way to sort of that, Japan, Europe, Eurozone situation where, again, the Bank of Japan owns close to the entire government bond market, and eventually they'll just own the entire bond market. They won't trade. Now, keep in mind that the Bank of Japan has pinned yields. They've pinned rates. So they basically have a mandate on what they will allow rates to go up by. And that's the same thing, as I'm telling you, is going to happen in Canada. It's been widely talked about by Tiff Macklem at the BOC. Everybody knows it's coming because households and businesses and all levels of society cannot tolerate a rise in interest rates. You can't have the 5-year mortgage go from 1.8 to 2.8 because everything blows up. And then you have to think about it through a central banker's lens. So if rates go from 1.8 to 2.8, obviously that's going to be reflective in the value of real estate. So real estate will drop. The price of real estate will drop. That will create deflation. That will create a negative feedback loop in terms of the wealth effect, and that becomes self-fulfilling in terms of, again, the Bank of Canada's entire mandate is a 2% inflation target. You can agree with that or disagree. That is their official mandate. Achieve a 2% inflation target. So if you have house prices dropping and then people stop spending because house prices are dropping, they feel less wealthy, again, that creates this deflationary force, and they're going to continually miss their CPI targets. So hence why the Bank of Canada continues to plow through, despite real estate prices rising right now by double digits, despite what they're doing to destroy housing affordability, they do not care. Their entire mandate is 2% inflation. And it's a terrible metric to begin with because everybody knows the CPI basket is completely flawed. You can't have a national basket of CPI. You can't have the same basket for people that live in Vancouver. A 30-year-old that lives in the city of Vancouver, the most expensive property market arguably in the world next to Hong Kong, and then have a CPI basket for somebody that lives in New Brunswick, a 60-year-old individual that lives in New Brunswick. They have two different rates of inflation, but yet you're doing a national basket of 2%. So this is why you continue to create these wealth disparities across the markets. And again, we're going to this nationalization of the bond market because when yields start to rise, they'll be forced to come in and buy more and more in order to prevent a deflationary feedback loop. And that's the same thing that they're doing in the stocks. So the Bank of Japan now, again, just look forward. That's like Canada's and the rest of the world's, that's where we're going, is towards this Japanification of financial markets. The Bank of Japan is the largest shareholder of the Japanese stock market. Okay, so what they do is they print money and they buy ETFs. They buy the Japanese ETFs. So they are officially the largest shareholder in the Japanese stock market. Okay, so you take freshly printed money and you buy these stocks. And again, the argument for this is that they need to create, they're trying to create this wealth effect. They're trying to, by supporting asset values, they are trying to use that to basically help drive consumer spending and to keep inflation. Again, the Bank of Japan continues to miss their 2% inflation target despite all these metrics. So what do? It's like a psychotic person. They continue to print more and more and more and more, buy more stocks, buy more government bonds, do anything. Just keep throwing the kitchen sink at the wall, and eventually they'll hit 2%. So this is the central banking end game, where eventually they nationalize, the stock market. You can imagine that your largest shareholder now in a company, for example, is the Bank of Japan. So could you imagine, for example, like the largest, hypothetically, if Canada was to go down that route, like Tiff Macklem at the BOC is now the largest shareholder of Shopify. Like, obviously we're a ways away from that, but like that's essentially like where it's going. So it's creating, nobody really knows how this end game eventually plays out, but you certainly have this nationalistic, phenomenon playing out, and that's kind of where we're going, and that kind of leads down the path now of these central bank digital currencies, which we've talked about in a couple of videos ago, where essentially it will give the central bankers the ability to start to manipulate and have more control over the money supply. There will be less reliance on commercial banks to actually pass through monetary policy. So for example, one of the things that you could do is you could have you could impose various yields or interest rates on certain individuals. So for example, let's suppose that you're a wealthy individual that has done tremendously well during this recession pandemic, and you're sitting on a lot of cash. Okay, well, hey, what's good for the economy is not for you to sit on your cash. What's good for the economy is for you to spend money, because 65% of GDP is consumer spending. And we are going to penalize you because we see that your cash balance in your checking account says $200,000 sitting in your checking account. We're going to impose negative 2% on your money every year until you start spending that money. And so that is what the ability of this central bank digital currency, again, could hypothetically is something that they could certainly do. So I guess you suppose it would allow them to be more efficient. And this is actually something that Chrystia Freeland, the finance minister here of Canada, actually talked about in a recent interview, trying to unlock the $90 billion of cash that has been saved up during this pandemic. Let's clip to her thoughts right here.
I want to thank you, first of all, for really zeroing in on the preloaded stimulus idea. None of us have a crystal ball, but economists like Ben, like Doug, have been pointing out that some Canadian households, and it tends to be the better off households, do have quite a lot of money that they've saved because there hasn't been that much to do in the pandemic. And certainly it would be great if that money could go towards driving our recovery. And I want to make an offer now to all of your listeners. If people have ideas on how the government can act to help unlock that preloaded stimulus, I am very, very interested. Maybe, as Doug Porter was suggesting, it happens by itself. That's the best case scenario for me. But if people have ideas on how we can really, try to unleash that, and particularly unleash it in the parts of the Canadian economy that really need support, tourism, hospitality, domestic services, let me know.
So what she's trying to say is that Canadian households have built $90 billion in spare cash, typical in a recession, that people will save money because the economic outlook, the future is uncertain. So you save money, you build cash reserves. And one thing the government is trying to do, or clearly is wanting to do, is to unlock that cash. So they need to find creative ways to get you to get off your cash pile and start spending that money. Because again, as I talked about, 65% of GDP, give or take, is consumer spending. That's how the world goes around. One person's spending is another person's income. And again, it would be much, much easier now to incentivize people to spend that money if you had the ability to directly influence who gets paid what rate of interest on their cash. And again, as somebody that's sitting on a large cash pile that has done tremendously well, will be imposed with some various form of negative interest rates. So that is, again, I think where we're longer term, where we're going, it's many years away. I think, well, not many years, but at least a couple years away. But I think that the evolution of central bank digital currencies is obviously coming. This is not a secret. It's been written by every single central bank out there. There's so many papers out there. So as always, we try to take these stories and apply them to how they will impact the average Canadian. So I hope this video brought you some value, entertainment. As always, hit the thumbs up button, subscribe, and we'll see you next week.